Be Wealthy and Smart, episode 214.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, you're going to learn why contrarian indicators move opposite to the crowd, and 5 reasons why you need to be a contrarian investor. Have you heard of the British economist John Maynard Keynes? Well, he identified features of financial markets that subject prices to what he called herd-like behavior, and he also called it like animal spirits. Here was his quote: "The herd-like nature and influence of animal spirits in financial exchanges and its potential to shift independently of changes in objective facts is, according to Keynes, a primary ineradicable source of economic stability." Well, that's a mouthful, but suffice it to say, in over 25 years being in the financial industry, I have never heard of the term animal spirits. And I'll tell you, the weird thing is that I've been seeing it in so many articles right now. It's in all the media. So really strange that the media is talking about a term that I don't even remember hearing about and talking about it like it's commonplace in the financial industry. What is that all about? Well, I don't know. I can't say. But what I can say is that his quote is basically saying something true, and that is that groups move together in crowds and that it impacts markets. So it's just that there is a group type thought process that goes on. Crowds think alike, and it's an interesting concept. It does actually go along with cycle theory. And it's interesting that I've been seeing it in Bloomberg and Barron's and other financial websites. Even the cover of Barron's, well, it doesn't mention animal spirits, but it does say Dow 20,000, which really is kind of preconditioning you to expect that the Dow is going to go there. And so I looked inside of Barron's for actually an indicator that I like to look at, which is about what crowds are thinking. And it's called a consensus indicator. And consensus is polls that are done with the public to see, are they really bullish, thinking the market's going to go up, or are they bearish, thinking the market's going to go down? Because it's been proven that whatever the crowd thinks, they're usually on the wrong side. And when these indicators get over 60% in one direction or the other, they become a very reliable indicator in terms of what is the next direction for the stock market. So I had to look inside my Barron's on Saturday and find out what the consensus currently is. And the consensus is 63% bullish right now. 63% bullish is very high and is a very bearish indicator. So again, when everybody's thinking in one direction, it means the market's about to go in the other direction. So here are the 5 reasons you need to be a contrarian investor and think about maybe a different direction than what the crowd is thinking. So number 1, when a good investment becomes obvious, it's usually pretty late in the game. This means that when you're judging solely by price, something has gone up a lot in price and you've been kind of chasing it, or you're following it and judging it because the return has gone up a lot. Let's say it's gone up 100%, or the Dow's crossing 20,000, and you're one of the last ones in. It means that you might want to think about being a contrarian at that point. I often tell the story of during the technology boom, how there was a tech fund that was up 100% in 1999 and took in over $1 billion in new assets at the end of that year after that performance number came out. Well, of course, everybody wanted a 100% return. They all wanted to double their money in 1 year, so they all jumped in, and it literally took in $1 billion of new assets. But over the next 3 years, that fund was down over 70%. So people that bought in at the very top lost 70% of their money if they stayed in all 3 years. So we often can be getting in right at the top, and you want to be conscious of that, because when things look so obvious and like a sure thing, you're looking in the rearview mirror, and it's probably not the direction that it's going to continue to go. It's probably about to go the other way. Number 2, when bullish consensus is over 60%, everyone who's going to invest already has. Like Joseph Kennedy, John F. Kennedy's father, said when a shoeshine boy gave him a stock tip in 1929, he said, "Everyone is already in the market if the shoeshine boy is giving me stock tips." So he went and sold all of his stocks and avoided the 1929 crash. So that bullish consensus tells you there's a lot of people who are thinking in one direction and the market's ready to move in the other direction. Number 3, most good investments fly quietly under the radar for a long time before they are recognized. They tend to be out of favor or unnoticed by many before they become obvious and the crowd jumps in. Everyone is still talking about oil, for example, while hedge funds have been investing in green energy for over 10 years. So those are the kinds of things you want to think about. What are trends that are changing? What are new things coming up? What's new technology that could be the next green energy that might be adopted as the standard in the future? And start taking a look at that. Number 4, you want to buy low and sell high, right? Like that is the whole concept of making money in the market, as Will Rogers famously said. But how can you buy low if you're buying in at the top? If you want to buy low, shouldn't you be buying the dips? So just something to think about. Number 5, keep from getting emotional. That goes back to animal spirits again, I guess, but I'm talking about FOMO, which is fear of missing out. Sometimes people fear they're going to miss out on the Dow crossing 20,000 and it's going to go straight to 50,000. That's irrational. And catch my last podcast about why that's not going to happen. Just the one I did right before this. I talked about my friend who thought that the Dow was going to go directly from 20,000 to 50,000. Truthfully, the market looks very overextended here. We're due for a pullback. But even when markets start to run away from you, it's usually that it's overdue for a pullback and it gets a more pronounced one. As a famous investor said, the best time to buy a stock is when blood is running in the streets. I know it sounds kind of gory, but that's what he said. Remember, you're buying businesses, so think, when is a business earning the most? When is its numbers and profits the best? Just like you can buy houses in December for the best price and least competition, you can also buy companies that way. Here's the thing. If you're buying an ETF for the long term, it doesn't matter so much when you buy because you're going to hold on to it for 10 or 20 years. The odds are in your favor to buy and hold than to try and jump in and out or be a day trader. So try to dollar cost average in, buy at regular intervals, and hold on for the long term. Have you gone to my website to get 11 quick financial tips to boost your wealth yet? Go to lindapjones.com and get your free PDF with 11 quick things you can do to get your wealth moving in the right direction today. That's lindapjones.com. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.